Hi everyone, welcome to another episode of Mama Boards by Apps Flyer. My name is Siberia Su. I'm a Director of Marketing for Braavo, a category-defining funding platforms that provides on-demand funding for mobile apps. Today, we're going to talk about funding strategies for app growth. Firstly, let's look at what is fundraising. In the history of humanity, nobody ever said, I love fundraising, because it's not easy. Basically, you're asking people for money to execute on your vision. Whether you are a founder or a marketer, you need to be able to tell a story about how you need to use the money to achieve a desired goal. Now let's look at the challenges of fundraising. Firstly, it is very time-consuming. It takes your energy, time away from entrepreneurs to really focus on their day-to-day business. Secondly, as mobile entrepreneurs, you may lose control of your business when you raise venture capital. And a third, a lot of founders are actually not familiar with all the funding options they have. They think they may only have two options that are bootstrapping, meaning funding from your own money, or raising venture capital. If you're an app entrepreneurs that are trying to build a unicorn from conception to massive success, we're assuming that you're not going to bootstrapping your business throughout the lifetime. So let's take a look at different types of funding at different stages. At early stage, what we call it the plan stage, usually the goal for business is to set up yourself for the next round of funding by building your MVP product, evaluating market opportunities, and building your core team. And the funding options that you have during this stage are including bootstrapping, monies from family and friends, angel investors, and incubators and accelerators. With incubators and accelerators, they typically don't provide much capital, but what they can do is to provide you education, mentoring, growth strategies to help you scale your business for the long term. And if your business does okay at the first stage, planning stage, you slowly move on to the build stage. At the build stage, the goal of your business start to grow your user base. You start to assemble your core team and expand the team size. And you will be preparing for the next round of funding. And broadly speaking, you're trying to increase the valuation of your company. At this stage, VC venture capitals usually play a pretty big role in hope to get a much higher return and exit down the road for your business. So essentially, you're selling a piece of your business with a valuation of much higher multiple down the road in exchange for the money that you will be getting. And if you are a gaming apps, some of the larger gaming studios and publishers may step in at this stage if your business have demonstrated profitable growth trajectory. They may start to acquire you or start to take a stake in your business as investment. And if your early metrics look strong, at this point, at the build stage, specialty financing may already step in to give you options to increase the liquidity of your business and give you options to expand your capital runway. Specialty financing usually comes in the form of cohort-based financing, performance-based financing, future account receivable-based financing based on the actual performance of your business. And if everything goes well, that your business really start to scale and demonstrate long-term profitability and start to generate large sums of revenue, you start to move on to really the third stage, what we call fuel the rocket ship. And that's where you really wanted to take your business into a real rocket ship, or what we call a unicorn. At this stage, you're really aiming for the long-term profitability and the sustainability for your business. You will need to start to raise capital to fund your user acquisition or invest in new titles, new games to really expand the long-term revenue potential for your business. And this is where you need to look for venture partners like private equity, or sometimes you start to look for large sums of non-dilutive bank debt that can continuously invest in your business and scale for your long-term growth. When it comes to fundraising, it is really about finding the right tool for the right moment of growing your business. Let's look at this chart. VCs, as we all know, are usually on the higher end of risk and the cost. They usually come in at a relatively early stage in hope to get a much higher return down the road of your business. And on the other side, bank debt usually is on the lower cost and the risk end. However, the entry bar of getting bank financing is relatively higher because as a business, you have to have proven profitability in order to be qualified to get a bank debt. And you would have to show your organizational maturity as well and the sustainability. Somewhere in between, specialty financing also has relatively lower cost and risk. However, the entry bar of specialty financing is higher than VC as well in the sense that you would have to prove proven ability to generate revenue as a business in order to be qualified. As mentioned before, the types of specialty financing include factory financing, cohort-based financing, future receivable-based financing. Mostly it's based on performance of your business. Now let's look at pros and cons of debt and equity, two most discussed types of fundraising solutions. With debt, it is cheaper and faster to raise. It is a type of non-dilutive fundraising option that doesn't require you to sell a piece of your business. The downside of debt is encumbrances, such as liens and performance covenants that usually require you to repay over an extended period of time of your business. And if you're not generating regular revenue and your business expenses are high, that can be a problem. Now let's look at equity. As we all know, equity is expensive to raise and it is very time consuming. It takes your attention away from really operating and focusing on the business. And also, it has higher bar to exit depending on the return that your investors want. However, equity does help you build your enterprise value. And if you're really looking to build a unicorn type of startup, you would have to raise equities for your business. It is very hard to sourcing strategic, cheaper capital if you're really looking to build a massive, successful startup. Now let's look at how funding impact economics of user acquisition. There's a quote from the CEO of Social Capital, who once said, roughly 40% of venture dollars goes to paid acquisition. That is a lot of dilutive capital that goes into the day-to-day business operation. What if you can replace this with something that you have control with, something like Braavo? And the second quote is from the founder of Verve, a top-grossing fitness app. She said, every dollar not spent on user acquisition is lost future profits. In the context of average lifetime value of users is larger than your customer acquisition cost. You are basically leaving money on the table to not max out your user acquisition potential because you're not getting the maximum potential of your future cash flow. Now let's look at this chart, stacking cohorts. This chart explains the rationale behind why not spending hard on UA early on is going to make you lose future profits. Let's take gaming apps, for example. Whether you're a casual game, mid-core, or hardcore game, there's usually a payback window of 3 months to 12 months to even longer for you to get the money back from your user acquisition dollars spent. And this blue chart sort of explains the revenue tail of the cohorts that you've acquired over the years. And as you can see, there is the long tail of the revenue that you generated from the money that you spent early on to acquire these cohorts, which sort of explain the importance of stacking as much cohort as possible early on in order to recruit revenue in the future. The more you can spend at a profitable ROI early on for your future cash flow, the more you should be pushing. Therefore, you don't lose money on the table. Lastly, let's look at a quote from Caesar, co-founder of Fanity, a top grossing app and a client of Braavo's. He said, equity investment is a great option when you want to create a new title or expand your team. But when you have predictable revenue and confidence, that you will get the money from investment back, other instruments make more sense. So if you know that you have a profitable growth trajectory of your user, it may make more sense to explore some of the non-dilutive funding solutions before you go out and raise another round of capital. To summarize our talk, when it comes to fundraising, there are two important things. First, it is important to remember the goal of your business operation before you go out and decide the type of funding to pursue. And the second, it is crucial to scale your user growth to full potential early on to max out your future cash flow and profitability. That's it for today. If you have any comments, please leave it in the sections below. Or if you have any questions around funding for mobile apps, please visit Braavo's website. Or if you're interested in watching more Mama Boards, subscribe here. Thank you.